नितिन भाई, हेलो हेलो हेलो। 46 में हम लोग को बेचना है, ऐसा बोल रहे हो ना?
मैं बेच रहा हूँ 46।
अरे, मेरे पास
हम लोग
मैं
को भी
आप
बेचना है अभी, हमारे
फोर्टी
पास
फाइव
भी
में मैं
निकल
देती हूँ आपको।
Hi, Saurabh.
Hi Pankaj, how are you?
All good, all good. Yeah. We'll just start in 5 minutes, yeah?
Yeah, no worries, no worries.
Saurabh will start, like others will join. Yeah.
Yeah. Perfect.
Okay.
So, thanks, Pankaj, for organizing this call. Quick introduction about myself, and I will quickly take you through the group, and then we will get directly into the product specs that are there. I have been a part of the industry for almost now more than 2 decades. I was there with Deutsche Bank on the products and advisory side. Then I was looking after Barclays Bank on the investment advisory side of the business. From there, I moved on to look after a single family office where I was looking at their family wealth, as well as I was also deploying the treasury money into the markets. Post that, met Nikhil Kamath. He wanted somebody to head the PMS, AIF, and wealth vertical for them. So I was doing that before I joined Torus Group. So Torus as a brand is a part of Cosmia Financial Holdings. This is promoted by Somen Ghosh, this Sam as we call him fondly. Sam has more than 3 decade long history into the Indian markets. He was so
Yeah,
he
can you?
was the yeah, sure. So he was the person who brought in aliens into the country with Bajaj tying up with aliens. So he was the CEO there. Then he moved on to Reliance Capital to become the group CEO for more than a decade time. And then later on, he started this group. So Cosmia Financial Holding is broadly a 3-year-old company in that sense. And we are present across multiple verticals, including PMS, AIF, for which I am the person looking after it, and we are also in the foray to get a mutual fund license shortly, as well as we have also applied for a general insurance license. So this is broadly how the group is organized. Coming to this individual product is a very different kind of a product that at least I have seen from a very product lens in that sense. So when I was told that we are trying to launch a product that will hinge on asset reconstruction companies and offering 17 to 18% net of fees and expenses return to clients with 3-year time horizon, I was little baffled in terms of how are we going to achieve it. And slowly, when I started to get into the basic details of it, what we realized was we are only looking at retail side of the asset reconstruction piece. We are not going to take any exposure on the corporate side. Obvious reasons being that a single corporate that goes, say, into NCLT or into bankruptcy, normally when you bid for that particular company, including the assets, the plants, and everything that are there with them, the normally bid size is from 100 crores to 10,000 crores that you get to see. So A, the ticket exposure is very high. B, there will be enough and more litigation so that the older promoter retains the control that it is there. Part C is that to unwind and re-energize this particular entity, it takes good 10 to 15 years to come back into positive cash flows. All these three elements deterred me to kind of not to get into the corporate side of the space. And that is where we ventured into the retail side. Now, when we talk about retail side of the asset reconstruction companies, we are talking about 5 pools, namely MSME loans, education loans, personal loans, credit card loans, or auto loans. These are the 5 pools that we broadly take exposure to. One thing we are very categoric is the individual outstanding. So every person who's outstanding is contributing to the entire pool should not be a very high amount. So except credit card as a pool, we try to see that the majority of the exposure is below 5 lakhs from individual borrowers that are there, which have gone defunct. In case of a credit card, we have exposure less than a lakh of rupees. A sweet spot when we look at a credit card loan that has gone into a NPA is broadly 50,000 rupees. So the idea is the moment you are having large number of borrowers with smaller ticket size at an individual level, their wherewithal to fight you out legally is very limited. And the moment you go back to them and tell them, "Ki, boss, you need to settle your loans for you to be eligible to get a loan ever going forward through the normal banking route or the NBFC route," these guys are more than forthcoming to get into that. So that was the first element that we wanted to look into it. So recovery becomes a very critical element in terms of us making returns. Now, how do we make returns? What is the process around it? So I will elaborate that a little bit. See, any ARC on the retail side, if you look at it, by virtue of the pools that are there, they will try to juice out the pool and try to recover money from the pool for at least 5 years. RBI allows them to go up till 8 years, but normally all these guys will go for 5 years. RBI is after their life, after the bank's life to clean the balance sheet, and the banks are literally forced to declare the NPA and clean out the NPAs by auctioning the pool out. So if there is a pool of 100 rupees, principal outstanding of 100 rupees, that gets declared as NPA and the bank is auctioning it off in the market. ARCs will normally bid for it. There are 28 ARCs. Broadly, 4 ARCs have some retail exposure. So generally, retail pools will be taken by these four entities that are there. Normally, we get to see that 100 rupees of principal outstanding gets sold in the market or gets auctioned in the market at a discount of 60%. So the pool will be subscribed at 40 rupees. 100 rupees pool, discount of 60, getting subscribed at 40 rupees. A special purpose vehicle is made and this 40 rupees is contributed there. Some portion will be coming by the ARC and some portion, if there is enough juice in the pool, will be put in by the bank who is auctioning the pool. So remember that the bank is literally forced to knock off the pool from their books. And as an entity, they will be exposed to every borrower that they have lent the money. So they will understand whether if somebody wants to do a proper recovery of the pool, is there enough juice available or not? If they find that the recovery could be good, these guys will want to have a meaty pie of the SPV that it is there. Usually, we get to see that 80% exposure of the 40 rupees. So that is 32 rupees is put in by the banks and 8 rupees, which is 20% exposure of 40 rupees, is put in by the asset reconstruction companies in the pool. Bank becomes a sleeping partner. They have now no role to play in terms of recovery of the pool or management of the pool, and they continue to do their banking activity as they were doing earlier. For managing the pool, asset reconstruction company gets 1.5 to 2% as management fees on an annual basis on the pool that is there. So, for example, at 40 rupees of the pool, they will get 1.5%, which is say 60 paisa is what they will be getting on an annual basis. First year it will be 60, second year it will be 50, so on and so forth. For 5 years, they will juice out the pool. So 5 years, they will get this cash flow that it is there. This entire game is of recovery. So every penny that gets recovered by the asset reconstruction company, they get a collection fees of 20% from every penny that is recovered. So what we have seen is generally when a bank is taking 80% exposure and ARC is taking a 20% exposure in the pool, over 5 years period, the recovery rate is between 60 to 70% of the 100 rupees of principal outstanding. And in the first year, broadly 15 rupees is recovered. So on 15 rupees, 20% becomes the collection fees that it is there. So 3 rupees is coming back to the ARC. So 60 paise and 3 rupees is going back to the ARC in year one. From 15 rupees that is recovered, take off 3.6 rupees, 11.4 rupees remains. 80% of 11.4 rupees is gone back to the bank. Rest of the money, 20%, is coming back to the ARC. So if you do the maths of zero point 0.6 plus 3 plus say 2.2, 2.3 coming back to the ARC, in the first year, on a very conservative side, they get from 5.5 rupees to 5.9 rupees as the range of the money coming back to them in year one. The moment I extrapolate it to 1.5 years, the entire recovery of principal of 8 rupees that ARC has invested into the pool, they would have recovered back. And the moment I take it to 5 years, the returns made on this investment of 8 rupees is northward of 24%. As a fund, as I mentioned, we are running a 3-year fund. I have only one basic issue that is uncomfortable to me, which is the time period that the ARC is looking and the time period for which I am running the fund. There is a mismatch of 2 years. ARC runs for 5 years. I am running the fund for 3 years. Part B is what do I do if there is a under recovery in the first few years of the pool management that is there? Who takes the risk? Because my investors are limited for 3 years and they are not exposed to 5 years. What we do is we are sponsors to an ARC, which is Reliance ARC. This company has been there in existence from last 13, 14 years, profit making venture. What we do is, since we are sponsors to the company, we get into a legal agreement, a back to back agreement with them, stating that the moment the pool completes a tenure of 3 years with you, on the money that we have sourced for you, you are going to take it back and offer to my investors a return of 20-21%, and you keep the pool for yourself. They are happy with it because their returns are never less than 24%. We are happy with it because I am sticking to 3 years. I am negating the risk of under recovery. Part C is that if I just look at the pool and the returns that it has made for 3 years, it is somewhere in the range of 17-18%, not 20-21%. Sorry. So from both sides, the risk and the returns is taken care of. And we will be a very small part of the entire books of Reliance ARC. So they are in excess of 3,000 crores. I am running a fund which will where we will get 100 crores in terms of the size that it is there. So that way, it is something that is mutually cohesive in that sense, and we negate all risk that it is there from the entire scheme of things that it is there. The fund has a management fees of 2.5% for funds less than 5 crores. There is an operating expense of 50 bips that it is there. So if you shave off 3% from 20-21% that we receive on the fund level, we are left with 17-18% as annualized return coming back to investors. The good part of this fund is that you will not need to wait till year 3 for maturity and the proceeds to come. We are, it's an AIF CAT 2. So that is where we are taking the money in two tranches. The first tranche is in the next month, which is March. The second tranche of money, we will be taking it in August, September, which is 6 months from here, from the same investors. And we will start a quarterly payment to the client starting from January 2025. So every quarter, broadly, a ballpark number of 5% will be coming back to clients in every quarter that they are invested with us. And at the end of 3 years, whatever is the remaining amount will come back to them. So you don't need to wait for 3 years for your money to come in. It is AIF Cat 2 platform. So minimum amount is 1 CR, broken up as 50-50% into two tranches. Broadly 3-year close-ended product that it is there. And if you see the cash flows and the returns that it generates has nothing to do with the movement of equity market, nor it has to do anything with the interest rate movement, whether it goes up or it comes down. It has absolutely no bearance on that. And it is an absolutely diversified pool that it will be there. We will be taking at least 6 to 8 pools in the fund that it is there, and they will be the underlying loans will be absolutely be different to each other. So some will be education loans, some will be MSME, some could be credit cards, and so on and so forth. That will be there. So while the individual pool is again diversified amongst itself, but in nature also we are diversifying it out. One last thing I would like to mention is that when we take the pools from entities, we primarily take it from public sector banks. The reason is very simple. The private sector banks will scrub the pool once, and public sector banks have no kind of motivation to scrub the pool, and that is where we like going with public sector banks. My IRRs tend to increase. The moment I go to a private sector bank, my IRRs will reduce a bit. And since we are the largest players in the market, we get to choose even the demographics of the pool that we wish to go with the bank. So our preferred location or our preferred geography is South as a territory. So we like to have exposure to Tamil Nadu, Kerala, Karnataka, Andhra as states. And that is our sweet spot to look at.
Saurabh, we can't hear
A
you.
recovery team which helps. And is it okay now?
Now it's okay. Now it's okay.
Yeah, sorry. So I will repeat. I said that it's a digital recovery that we do. It is not a physical recovery that gets done. And we have a 250 strong member team which is internal to the ARC that it is there, which has been functioning from last 13-14 years, so has good experience in terms of doing the digital recovery. And the success rate is immense. Half of the team sits out of Bombay, which is Sakinaka, and half of the team sits out of Chennai, which again, courtesy of the location that we want to target, that is where people are present. So this is broadly the specs of it. I have one question from somebody. So we are intending to do the first close between March, April of this year. The tenure gets decided from there. So whenever the first close happens, it is 3 years from there. So as a ballpark number, keep it as March to April 27 as the maturity that you will get to see in the fund. So this is broadly the fund. Any queries, more than happy to pick it up.
So team, if you have any query, any question, you can post it. Or if you want, I can unmute you. So Saurabh, what should be the risk profile for this kind of risk profile of the investor for this kind of fund?
Yeah, Pankaj, very interesting question. And when I interact with family offices, this comes eventually every time that I do. See, I am not targeting the equity portion of the client's book. I will not be able to compete with the returns that one looks at from an equity market that it is there. So this is an allocation that one should be looking from the non-equity side of the book, where typically one is looking at a much stable return coming back to them. So we get to see many types of products coming in terms of credit opportunities and this and that, where the outcome is binary. So if a default happens into a particular paper, your returns get completely jacked, and your principal even is not kind of you are not able to get. Here, the return generation happens in a very different way, and that is where that risk is completely mitigated. So it should be from the non-equity portion of the books.
Okay. So team, any other questions?
So the question is, if 5% is the quarterly distribution, that means 40% will be returned at the end of tenure. Broadly, see, it is 3 years, so 4 into 3, 12. Broadly, you should look at 10 quarters at least. For 2 quarters, I am not giving the payouts, which is April, May, June, July, August, September. I'm not giving the payout in that period. So broadly, 45 to 50% should be the payment that should be returned back to the client before the entire fund matures. It is a Cat 2 fund, so there is no taxation at the fund level. It's a
Okay.
complete pass-through like a mutual fund.
So for an individual, it will be like a 30% kind of thing.
Yeah, so take MMR. So if I put it in a very broad way, if you're getting a return of say 17, 18%, you should be looking at say broadly 11.5 to 12% as post fee, post taxes, everything taken into account. That is the return that you should be looking at.
So you are saying 11 to 12% post tax, post
Yeah,
expense.
post everything. Yes, in net in hand, broadly. I'm taking MMR for everything. So one third is basically I'm just deducting it off on the face of it. So that is what you should end up with.
So one question we have, can you break down the sources of returns? Management fee, recovery.
Yeah. So broadly, see, as I mentioned, there are three pools from which the asset reconstruction company will get the money. The first section is management fees, which is on the 40 rupees exposure, which keeps reducing every year. You will get 1.5 to 2% as the management fees. Let's take conservative as 1.5%. So if 40 rupees is in year one, you get broadly 60 paisa coming in from there. The larger share you get it from the collection fees. So every penny that gets collected, courtesy of the recovery efforts that are done, for that the collection fees is at the rate of 20%. So say assume 15 rupees gets collected in first year, 15 into 20%, which is 3 rupees will come back to you. Deduct from the recovery, total recovery that has happened in the first year, deduct all these expenses, management fees and collection fees. The net remaining will get passed on at the rate of 80% to the bank. 20% will come back to the ARC. So these are three pools. from which the money is made. See, the ARC is one. There is a specific reason why we are looking at only one ARC. So I have the flexibility to go to any asset reconstruction company that it is there. My problem is the moment I go to any other asset reconstruction company that is there, they will give me a haircut on the management fees and collection fees. So that will reduce my return to certain extent. Part C is that I will never ever be able to figure out what kind of a pool I am latching into because I will give you a live example. One of the ARCs offered me a pool. We went into the term sheet and everything, only to realize that that pool was doing the rounds in the market from last 6 to 8 months. Nobody was picking that pool. So we don't want to fall into those traps that are there. And promoter of our company also sits on the board of the ARC that we are talking. So I have a complete transparency there. And since we are sponsors to that ARC, that is where I'm able to get a back-to-back agreement done with them. Otherwise, if I go to any other unrelated ARC, they are not going to give me an agreement where they are giving me kind of a guarantee of 20-21% at a fund level. So that becomes a challenge. So ARC will be one. Public sector banks can be any that it is there. We have done business with Union Bank. We have done business with Indian Overseas Bank, SBI, PNB. So we keep getting those pools. The pools will be from multiple PSBs. So it won't be from one.
Saurabh, like 36 participants are there, but mostly they have joined at a later stage. Like, so if you
Okay.
don't mind, can you just brief into like in 5-10 minutes, like if you don't mind, please.
Yeah, no worries, no worries. So, see, again, basic concept, this entire cash flows and the returns that get generated is because we are using a unique platform, which is asset reconstruction company. Very crudely speaking, these are called the bad banks in the country. Uh, these entire ARCs, so there are 28 ARCs in the country. They are under the regulation of RBI. So they were started under the aegis of RBI. So 2 decade old industry. Uh, these were constituted only because the balance sheet of the banks were bloating with bad assets that were there. And to keep the banking system healthy, that is where stricter norms on the NPA and declaration and auctioning of the pool was institutionalized by RBI. So several measures were taken over years. We partake exposure alongside with the asset reconstruction companies. And as I mentioned, the return at the fund level of 20-21% is made courtesy of three contributions that we get. So if a bank is declaring a NPA and has to auction it out in the market, 100 rupee principal outstanding loan that is declared as an NPA normally gets sold at 40 rupees. The moment bank realizes that if there is a good collection agency that is doing the recovery, they will all, and the recovery will be good in that, they will want to take exposure in the SPV that gets created at 40 rupees. Normally, we have seen 80% exposure they take. So 32 rupees is taken by the bank into the SPV of 40 rupees, and 20%, which is 8 rupees, is put in by the ARC. Bank becomes a sleeping partner, has no role in terms of recovery of the assets or management of the pool. ARC is the only entity that is doing all this activity. Hence, they get paid management fees as well as collection fees. Management fees over a period of 13, 14 years history I'm talking about is generally normally between 1.5 to 2% on a per annum basis. The pool is juiced out for 5 years at least. RBI allows it to juice it out for 8 years, but normally these ARCs will juice it out for 5 years. History has shown that broadly 60 to 70% is the recovery in 5 years. So 100 rupees outstanding, 60 to 70% will be recovered. First year, 15 rupees is the general recovery. So on 15 rupees, you get a collection fees of 20%, which is 3 rupees that comes to you. If you knock off from 15 rupees, the collection fees and the management fees, which is 3 rupees and 60 paisa, you are left with 11.4 rupees, which will get distributed at the rate of 80% to the bank. 20% will come back to the ARC. So if I put down the cash flows in year one, you have a 60 paise plus 3 rupees plus say 2.2 to 2.3 rupees coming back to you. So in a most conservative fashion also, if I put it, between 5.5 rupees to 5.9 rupees, you are able to get in the year one itself with an investment of 8 rupees that it is there. By 1.5 years, you would have recovered your principal in any case. And the moment I extrapolate it out to 5 years, the returns are north of 24%. The minimum returns that you will get to see in this entire scheme of things is 24%. I get a basic challenge here is that ARC is going to run it for 5 years. And if I create a fund for 5 years, nobody is going to pick it up because nobody understands this concept as on date. Maybe 2 years down the line, if I come out with a fund for 5 years, people will accept it. Today, people will not accept it. Hence, I wanted to come out with a 3-year fund, the minimum possible in AIF Cat 2. And that is where we get into a back-to-back agreement with the ARC stating that they will buy back the pool that was bought from my money, the AIF money that was there, and they will pay us back a return of 20-21%. It's a legal agreement that gets drafted between AIF and the ARC on day one of taking the exposure to the pool that it is there. They get a benefit of 2-3% that it is there because that's their normal activity to kind of juice out the pool on a regular basis. For me, it becomes a very safe and secure way wherein I am mitigating the risk of under recovery, if any, and the chance of going to 5 years or more on a particular pool. So both gets redundant for me. And if you look at the dynamics of the pool also, in 3 years, if I'm only exposed to the pool and there is no guarantee, I would make broadly 17-18% and not 20-21% on the pool that it is there. So I get benefited on that side. And that is where at a fund level, we get 20-21%. Shave off 2.5% as the management fees of the fund and 50 bps as the expenses, operating expenses. The investor is left with 17-18% as the net of fees and expenses return in their hand. And this fund is constructed in a way that you don't need to wait till the end of 3 years to get your cash flows. Every quarter starting from January 25, investors will start getting a quarterly payout close to 5%. I'm giving you a very ballpark number. It will generally be more than that, but broadly 5% every quarter, they will start getting the payoff. Now, there is one question I have not answered is why does the ARC need AIF money and not just go to any other funder or sponsor? The answer is yes, they can definitely go to any other entity. But understand that equity capital comes at a much higher risk that it is there. And ARC as such does not want to take debt risk into the books. So when we take exposure, we are in a way expanding their books, with say typically us demanding 20-21%. So it's not a very high cost for them. Uh, Plus, typically, they are not looking out for new investors that we are providing it to them. So they get fulfilled on that side. And any investor that comes to the ARC will not be able to take exposure directly to any other ARC, any ARC for that matter, because only QIBs can take exposure directly to ARCs. So investors like you and me will not be able to take exposure to the ARC and enjoy the cash flows that they generate. So we are creating an investor pool which typically has no experience in the cash flows of the ARCs. So this is a very new pool that even the ARC is getting exposure to. So that is the relationship that we have.
Saurabh, we have such funds in market right now.
See, honestly speaking, as I mentioned in my opening statement, also 22 years of me being in the industry, I had not come across such a fund before. So when I started to go to the asset reconstruction companies to understand what is there, how it is there, and does the industry have enough merit and will it continue and things like that, the basic due diligence question that we get into, I realized, and one of the ARCs was JMARC. I realized that I'm talking to a team which has done a distress fund earlier, and that the same guys had done it earlier. But they took exposure and they started it somewhere during COVID. I think it was a 5 or 7 year close-ended fund. It was only relying on corporate side of the asset reconstruction companies. So they took exposure to 4 companies. Unfortunately, all 4 of them tanked for them and they took a cash deal. So good question here. I will explain in half a minute. See, the first deal I explained to you is where a bank is partaking an exposure alongside with the ARC. There are deals, especially on the corporate side of the business, where the bank doesn't want to be involved at all. These are large deals that are there, and they will just tell the ARC, ki, okay, give me $10 or $12 and you take the entire pool with you, and whatever you do with the pool is your headache. We will not get involved. So this is an equity risk that the ARC takes. If they are able to spun it off, it will make huge returns for them. But as it happened in the case of GM, all 4 deals were cash deals, taking taken at huge discounts. So 100 rupees taken at 10 rupees, 11 rupees, and things like that. But none of the 4 deals saw the light of the day. So that is where it was a big disaster for them. And that is where they don't have an exposure and understanding on the retail side. So they never came out with a retail ARC backed fund. We are the largest players on the retail side of the business. So that is where we take exposure to retail side. We will never ever get into the corporate side of the business. Our expertise is not there.
Team, any other questions we have?
Uh, okay, so there is a question. Any reason to take South India pool, and what are your comments on bad loan cycle in retail? Okay, okay. So I will take the first part of it. South India, what we have seen is the recovery rates are better. The moment you send the first notice to them stating that your recovery is due and you need to pay back, uh, we have seen people are more forthcoming to come to you and negotiate, sit on the table and negotiate with you. So that is the reason why we take exposure to South India primarily. It doesn't stop us to take exposure to any other geographies in that sense. Only that our experience has been better with public sector banks and South India in that sense. That is where we try to go on a known path in that sense. And if you see the NPA in the economy and in the banking sector per se, close to 4.86 trillion rupees of NPAs are there. 30%, 25 to 30% exposure is towards the retail side. The rest is towards the corporate side. We have seen a trend where the corporate side of NPA is coming down, courtesy of the stricter loan giving norms on the corporate side that is being now institutionalized by the public sector banks also. So that portion is coming down every year. And if you see last to last year and this year, there is a significant reduction on the corporate side. Retail pools, we will expect that these retail pools will continue as people are kind of wanting to take more loans, increase their lifestyle and things like that. And at times, job market being in tizzy, the retail pool is not going to going to reduce. It is going to increase over a period of time. And that is where, when I was talking to the other asset reconstruction companies, some other companies also have started to look towards retail side of the business. So they will take another 2, 3 years for them to gear up to handle recoveries and other things. But even other companies have started to look at it. So the the trend is clearly changing from corporate to retail side. In 3 years, you will see a lot of difference there.
So this is fund two.
Yes. So the first fund broadly, we closed it out 3 to 4 months back. So we did the first quarterly payout in January of this year. It was not promoted outside. It was primarily a promoter-driven fund where we wanted to see that all the nuts and bolts that we are looking at are they being followed properly? Is there anything that we need to kind of do it out in a way which kind of tightens the entire fund structure? So the first fund was exactly like this, only that outside participation was not there. We didn't promote it at all.
Okay. And what was the fund size?
It was bare minimum 20 crores.
20. So any other questions we have? Saurav, I think we don't have any other questions.
No worries.
Yeah.
So thanks a ton to you and your team for the patient hearing. I will leave with the thought that look to allocate into this fund from a non-equity basket. The return profile is quite steady in nature. You will not get to see a return profile that is so steady. And post fees and expenses, the returns are quite good when you look at non-equity portion of the market that it is there.
Right. So even NRIs, they are allowed in this?
Yes, NRIs are allowed. NRIs except OCIs. So except expats that are there, everybody can invest. So in
Even,
fact,
even
uh,
USBs.
yeah, we US investors can also invest. No issues in that. NRIs based out of US can invest.
Great. Okay.
Perfect, Pankaj. Thanks a ton again for organizing this. And let me know if your team has any further queries. We'll be happy to answer it out.
Thank you. Thank you, everyone. Thank you. Bye.
Bye bye.